We're live to the inaugural Morning Crunch podcast. With us today, we have Omar, Mawji, and Grayson Andersen. Grayson, Omar, welcome.
Thank you, Denny. How are you?
Very well, thanks. And we've got Matt Wilson on the line, CJ Kim,
hey guys.
trusted friends and colleagues. All of us mining guys, and you guys are oil guys. We've been watching all of the craziness going on in Ukraine, all this fun stuff, and or not so fun stuff, I should say. It's actually horrific and tragic. But we've been, seeing oil prices on the move, and like the good market tea leaf readers we can see potentially a trade to be made on oil. The space has been cold for quite some time. So just, wanted to reach out to you guys and see what you guys thought about the space, and how do we play it? What do we do?
Well, it's a great question. Obviously, as you said, most of the oil equities have run quite a bit, both in, Canada, the US, and globally. I think from a valuation perspective, maybe some of the international things are relatively cheaper, but everything in energy is still cheap relative to the commodity price. And I think that's because, as you mentioned, the past 5 to 7 years has been a really challenging time for oil and gas. The ESG movement has made the world think that we don't need it anymore, or that it's uninvestable, or that it shouldn't be invested in. And the fact that we're over 100 million barrels a day of global oil demand tells us that, despite the fact that it has a carbon intensity component, we still all use it significantly every single day of our lives. There's actually nothing that we do that energy isn't a very large component of. So, with all of that said, whenever oil prices are low, they say that the ultimate cure for low oil prices is low oil prices, and the same can be said for high oil prices. So there is a point at which demand destruction will occur. We've just passed through the 100 barrel a day mark for both WTI and Brent over the last couple of days, the first time since 2014. And at some point, there will be people who feel the crunch and won't be able to fill their cars up fully anymore, and won't want to take that extra trip. We'll turn the thermostats down. And there are a lot of these measures being taken place to support the Ukraine. But it'll happen for an economic reason at some point if prices stay elevated.
Mm-hmm. Now, I mean, we've seen historically, last time oil made its run, it wasn't really paired up with inflation the way it is this time, right? We've had this crazy inflation, which we really felt. I mean, we felt it, on our store shelves. We felt it everywhere around us in terms of labor, et cetera. So this was all happening, thanks to many forces, notwithstanding COVID. What does this all mean for, oil running up along with inflation? Is this going to be like the singularity perfect storm where both these things go on a runaway tangent?
Well, that's the best question you could ask, because the last time we saw a hyperinflationary environment with higher oil prices was the early 1980s. The oil supply, the oil crisis of the early 80s, and there really hasn't been a scenario like the one we're in now since then. And in that environment, the best performing subsector within the investment community was oil and gas. It's not just energy, but as I said before, energy is a huge component in everything we do. The inflationary component has more than just energy as part of it. We've seen supply chain disruptions globally, whether it's computer chips for cars or, supply of vegetables and all that, everything that we consume because of, blockades in the Suez Canal or whatever. And, the one big story that I was looking at over the weekend that's not being reported or considered by many is that the world's largest logistics firm has been under a cyber attack for the past week. And if you think that doesn't have a ripple effect, it only took 2 days or I guess 7 in total for Toyota to announce that they were going to shut down manufacturing lines in Japan because they couldn't receive parts. So
So
much as
who is
everybody,
this logistics firm under a cyber attack? What the fuck?
it's based out of the Washington in the U.S. and that's how good it is. Nobody knows its name, nor is it ever reported. But it was a big story in the.
Doesn't this just reinforce the idea of, you know, having your resources close to home? And does this bring back to the table Keystone in North America? And you know,
my personal opinion is like large infrastructure projects in North America just aren't going to work anymore. I think there's like especially from Canada, there's just too much risk associated with, like, you look at the large projects, like the almost graveyard of them. It's like Teck, Trans Mountain, basically, you know, the news that came out last week. And then Keystone and potentially Coastal GasLink and LNG Canada. Like, it's just, you know, I don't think if we're going to see growth in like oil and gas, it's not likely going to come from North America. It'll probably come from markets outside, OPEC markets, Africa, stuff like that.
And this is because of ESG. Like,
yeah, it's ESG.
Really?
Like, I think, you know, for the longest time, we considered geopolitical risk to be like focused in on the Middle East because of what's going on there, or what was going on there. I think we need to reassess kind of risk in North America, because there's not a lot of appetite for large projects in Canada and the US.
But like, I don't understand the rationale behind that, Omar, because you're saying risk in North America, but we all live on Earth. So we're saying we'd rather get our oil from countries that have no environmental policy or procedures in place versus Canada, that like where we have the highest standards in place.
I don't think it's we'd rather get our oil. I think there's less oversight, and there's less, there's less, like, there's no cost of carbon in Egypt, right? There's a cost of carbon in Canada.
Right.
And so I think that plays into it.
So guys, does that mean, so last time there was the oil run up, right? So last time after the financial crisis, you had that big run up from 2008 until 2014. And so you had these huge Permian Basin projects, right? You had, you know, some of my favorite investments back in the day was like company Linden Energy, which just had this huge thing in the Eagleford. And, you know, they're in the middle of Exxon and Shell. And you had all these stories of these small companies amassing huge land positions in the Bakken in Montana. And you had these great juniors that everyone loved that, you know, eventually I don't even think any of them worked, but that was kind of the way to play it for 5 years. Is it was this land, this acreage kind of play with big shale, big resources, you know, kind of whatever the term is. That's how long it's been undeveloped, undiscovered oil. It's like I have 10 billion barrels of oil that I don't know if it's there, but it might be. But so whatever it was. Is that something that, like, you know, as you guys are playing the space, are you seeing with this oil run up? It's been so fast. You know, just a year ago, we were getting paid for oil to take oil barrels. So it's just, you know, a year and a half ago. But are you seeing that kind of come back in the space, or is the ESG in North America, is that just that crushing the junior space as well?
Well, the land grab that happened in North America between 2004 to 2017 is over. In fact, the number one risk of North American onshore unconventional is that all of the good locations have been drilled. There was such a rush to drill and such availability of capital that afforded these companies to pay stupid amounts for acreage that, so much so that potentially the economics didn't work. But the availability of capital was there, so that whether it was equity or debt, the majority of it was debt. All of that land now is being drilled up. And the question is, how many years of inventory does the best shale plays have, does the Permian have? And if you listen to the big US shale players, be it Pioneer or EOG or Devon or, the list goes on, all the big independents, they say that, we could drill faster, but we'd run out of inventory. We'd only have, if you were drilling your tier 1 or tier type A type prospects 5 or 6, 7 years ago, and those things were doing 2,000 barrels a day when they came on initial production. Those, if you're into tier B and tier C, those wells will only do 1,000 or 500 barrels a day. So you now have to drill 4 times as much, right, to keep up with the same level of growth. And we don't have the rigs available. We don't have the crews available. If you listen to the Q4 conference calls of those companies, they're all saying there's service cost inflation, but the service companies are saying there's no people and equipment to do it. We're drilling wells. The company I work for, Recon Africa, we're drilling wells in Namibia, and we kind of, we keep an eye on this thing, and we've bought 3 wells worth of pipe like 6 months ago because we knew, we had challenges on our wells that we drilled before with logistics. So we knew we'd have to order it and buy it and ship it, and it would take a while. So, fortuitously, we have loads of inventory of drilling pipe. So
if there's no inventory in the ground, Grayson, is the play in North America consolidation, and you're just looking at which guys are going to be picked up to replenish their reserves?
You're absolutely right, CJ. If we really believed in the long-term sustainability of oil and gas, every company with a cost of capital should be buying those who have good assets and aren't getting the same cost of capital.
And has there been a change in what a good asset is? I remember when I was looking at the economics of those Permian Basin wells, it was like, I think there was $60 break even kind of thing in terms of when you're drilling horizontal wells, and I think it was $2-3 million a well. And then you ended up, at $60 oil, these things would just turn off maybe? Like what? So did they, Chesapeake goes bankrupt in Pennsylvania, and you've got these shale plays that maybe couldn't survive when oil fell off a cliff. So is there that land grab, a different kind of land grab this time? Or is it just like, get out of Dodge, the people have the places that are, everything's taken, let's go.
A lot of the consolidation happened during the downturn. Companies went bust, acreage became available. People in the industry in the US especially, and in Canada, the Dave Wilsons of Kelt and the Whitecap guys, the Whitecap guys did an acquisition at the end of last year, and it paid out in like weeks given what the move in oil prices did. So, Grant Fagerheim and those guys are really smart industry guys who have been around a while, and they know the assets, they know the basins, and the same thing happens in the US. So the big opportunity was during the downturn. Canadian Natural Resources, the bellwether where I started my career in industry, they went out and bought all the assets they could in the downturn. Murray Edwards loves buying things when everybody hates it. Buffett-esque type stuff. Yeah. They bought all the oil sands assets that Shell and everybody else wanted to sell. So, there isn't really new opportunity. And this goes back to what Omar was saying. If you can't get pipelines built, you've got a bottleneck. And those pipeline permitting processes are going to take longer in the developed world because of the regulatory hurdles. But even as we're experiencing in the emerging markets, they're learning from the developed world. So you have to, there's no regulatory arbitrage you can even play anymore, because as a Canadian company with Canadian responsibilities, Canadian investors, they want to see you act as if you would in Canada. So, we have to take this Canadian expertise and move it to the rest of the world, which makes the industry challenging no matter where you go.
So, I'm looking at it as a matter of security over ESG. So, going back to Omar's point, I don't think anything is maybe you have some ESG mandates in the larger funds, investment policy statements and whatnot. But at a certain point, when do people say enough is enough, and we don't want to pay over $100 for our oil? We want to be able to heat our houses, so maybe we should cool it with certain ESG policies, because it feels like everyone has gotten so caught up in it, they don't really know.
Dude, I think we're there. It's funny you say that because whether it be, with COVID, everything we were getting all, we're kind of over the COVID thing. We could see there's already signs that we're over this whole environmental thing too, this global warming, climate change thing. I hate to say it, I'm not saying, rightfully or wrongfully, but it looks like we got bigger fucking fish to fry than climate change.
The issue is we can't be over it. We can't be over it. Because ultimately this comes back to a bigger issue. Over time, with 10 billion people on the planet, with the amount of stuff that we consume every day, we're going to run out of resources, whether it's copper, gold, lithium, gold, whatever it is, oil and gas, primarily, during the downturn and during ESG. And one of the things that the climate movement likes to talk about is peak oil demand, peak demand. When's peak demand going to happen? Well, I used to work for a guy called Matt Simmons who wrote a book called Twilight in the Desert where he talked about peak supply. We're going to run out of the ability to generate enough oil and gas for what we want to consume. So whether you're talking about peak demand or peak supply, the reality is we don't have an infinite amount of resource to develop over time. And now that we have a developed China and a developing India and a developing Africa, we'll eventually run out of resource. So
yeah, but that's fine. I mean, that's fair to say. Like, it comes from a good place. I mean, obviously, we have to get off of a dependency on oil, but is there a sense of urgency or an added sense of urgency because of some environmental catastrophe that's looming over us? And I think there has been a lot of fear mongering in that front. I mean, as a scientist, I did an undergraduate degree, and in my thesis, particularly in climate, I looked at the hydrological cycle and solar forcing on climate, and I realized that there's a shit ton of factors that play into climate change. I mean, climate change is real. No one's denying that. It's something that's been, happening forever, and it's going to continue to happen forever. We're not looking to preserve any sort of static nature of anything. The reality is all of this exceptional spending that we're doing going to turn the thermostat back, going to slow that process down. And even if it does, is it going to be insurmountable? Is it going to be some, chicken shit amount of change that really doesn't do anything? So are we going to wake up and say, okay, look at, plastics in the ocean's a big deal. Consumption, as you're saying, reliance upon petroleum, it's not an infinite resource. We have to get, used to or get thinking about moving off of it. But for now, if we're not spending and somebody else is going to, back to CJ's point, it becomes sort of a domestic security thing. I saw, we've been seeing like mainstream media, a lot of, at least right-wing media, like Fox and stuff have been, poking at Joe Biden and saying, hey, listen, Keystone Pipeline, if we were to simply flip that back on and start to get some of our energy and tap back into our domestic supply chains, then, we wouldn't either be in this mess or be as susceptible to what's happening with Russia, OPEC, and others. So like, I think what Omar was saying before is that's just a no-go, right? Omar, you were saying like, it's fucking bullshit, basically.
I just think from an investment perspective, like if you were to ask a private pipeline company to go build Trans Mountain or go build Keystone now, they'd probably tell you, no, we're not going to do that. Like we'd rather get Plains Midstream to build a pipeline from the Midwest to the Gulf Coast, and then someone like, carry the burden from Canada to the Midwest, right? And so it's just like, the investment, even if you look at Occidental's presentations, like they've started to put a price on carbon in their presentations. And so it really comes down to an investment thesis. Like if you're investing in North America, you just naturally have to factor in your carbon effect, right? And so that's why there's not that spending in North America. And that's why they're spending, that's why OPEC has become the new leader in oil and gas production, because they can increase capacity and they don't have to abide by certain ESG rules that we do, right?
So what's the trade? If I'm a generalist right now and I'm looking
what do we
at
buy?
this space, what do I buy?
So listen, I'll give a shout out to Eric Nuttall in Canada. All the Canadian energy companies are still cheap. They're all up whatever they are, 200, 300%, but they're all still cheap. They're all generating significant cash flow. The market, whether it's ESG or history, has told asset managers to tell companies, don't invest in production growth. I want a return of capital. I want to see dividends. I want to see share buybacks. And at $100 oil, these companies can keep production flat and take the company private in 3 to 5 years. So all the debt's being repaid. It's now about dividend growth and share buybacks. And it's not going to be production growth because, as Omar said, there's no pipelines that are going to be built to fill it in time. So, So when you look at the challenges, the companies are being disciplined, and it's the right thing to do.
So that was, I remember listening, I think it was a Bloomberg pod actually talking about that. It's really interesting how last time it was all about increasing production to the such a high degree and not worrying about, actual IRR, because you're just reinvesting capital into your wells all the time. And now they're doing the opposite of that, where people are more concerned about cash flow. So isn't there going to be a time where, oil chills out, I guess, and then production isn't growing and then you have a quick bounce again, where like all of a sudden you have this lack of production, and then we realize that we aren't off oil. So is there a way to like, is that, or is that not something?
There's no way. There's only one way the world can solve its lack of oil supply right now, and that's doing a JCPOA with Iran, which is, you know, again, from an energy security perspective, not great for the world. You can ask Saudi and the rest of OPEC to pump as much as it can. You can forget about what's happening in the Ukraine and ask Russia to pump as much as it can. But everybody outside of Saudi and Russia has not been able to demonstrate the ability to produce more over the last year when it's been needed. You know, the OPEC Plus cartel has agreed to a 400,000 barrel a day per month increase, and they've met it 3 out of 9 months. So the ability to produce more oil is challenged. In the developed world, it's because of ESG and regulatory concerns and access to pipelines and things like that. And in the emerging markets, it's the fact that oil prices were low a couple of years ago, so there hasn't been any investment, and it's just not available. Decline rates, and I talked about, you know, hard rock mining versus oil and gas. The worst thing about the oil and gas industry is a decline rate. That's why the oil sands are such a great asset. They have no decline rates. You mine it. You know, you don't worry about a decline rate every year like you do on conventional oil and gas, or unconventional is even worse. So if you're producing 1,000 barrels today out of a well, you know in a year's time it's going to be 800 barrels or 600 barrels or 500 barrels, and you need to reinvest that capital. So right now there's nowhere for the market other than existing inventories and stockpiles that have been announced by the US and Japan and Korea and today the IEA, that are going to use existing barrels in storage to help us with a supply-demand imbalance.
Okay, well, sorry, go ahead, Omar.
No, and I also think, like, I do think that there is, like, I mean, Saudi and OPEC, you know, they do have the capacity to potentially increase barrels, not to like make up for, you know, if 50% of Russian production was lost, but they do have the capacity. But I think the other thing is we're in a new dynamic where, you know, pre-2014, the US, no one paid attention to OPEC because they were like, the US is the swing producer. You know, they'll just continue to pump oil and we'll have, you know, we'll enjoy this ride. And I think that we've now realized that actually OPEC is the most, or at least Saudi is the most sustainable production source, right? And you know, the US will change. And so now the power's gone back to OPEC. And so OPEC is like, look, you know, we haven't enjoyed, you know, $80, $90 oil prices over the last, 6 years, 8 years. And so, yeah, maybe we'll kind of ride this out a bit. And I think the produce, like the independents, you know, even you saw Cenovus come out recently. They said, we're not going to increase spending because we're not sure if oil prices will stay where they're at, because really they're all at the mercy of OPEC right now. Right?
So what's this headline mean? I've got it here. It says, in this regard, His Royal Highness, the Crown Prince affirmed the Kingdom's keenness on stability and balance of oil markets and the Kingdom's commitment to the OPEC Plus agreement with Russia. What the hell is the OPEC Plus agreement with Russia? That just came out not too long ago.
That's the 400,000 barrel a day per month increase that they agreed last July to restore the supply-demand imbalance that was in the market following, you know, the resumption of economic activity post-COVID.
So unpack that for a second, because I'm an idiot.
Yeah. So during COVID, all the OPEC countries agreed to take a hit on their production. They shut in wells, they shut in production so that supply and demand would be balanced. And it didn't really work because oil went down to $30-$40 and negative for a day. But it eventually worked, so that as demand returned, as people went back to the office, as travel returned, they started to increase production, and they have been doing so consistently since July. They haven't been able to meet their quotas because the easy oil is not there. It just isn't there. So Saudi's the exception. You know, they probably do have a real 1 million barrels a day of spare capacity, but nobody else does.
So guys, if that's, I remember listening to a report where like the greenest oil in the world is also in Saudi because it's the most, you know, it's the most naturally occurring.
Yeah,
it's so much
super light. Yeah.
So I guess two questions would be like, looking at the way things are going, I guess you said the Canadian plays, but just as stock pickers among us. So is there kind of a way to play either like, when you're investing in a company, are you shying away from any sort of fracking, whereby fracking more heavy oil, where the ESG component of that is going to basically be a negative? One, and two, is there an area of the world that is not in North America? I remember last time, there was the shale piece in Argentina and Colombia, and you had all this stuff kind of going on in South America. Is there another place that you can go that kind of says, look, invest here because at some point you're going to have to go there?
So I think
go ahead, Omar.
Just in terms of like North America, Canada specifically, I think you're really just investing in these companies for free cash flow. So you would, just assume an $80, let's say long-term $80 oil price, figure out how much free cash flow these companies could make, and then assume that, they would exist for at least 20 years, right? 10 to 20 years. And depending on how much cash you can get from that, that's basically what they're worth, especially with the smaller producers. The larger producers, you could play that from an oil and gas perspective and an ESG perspective to an extent, because they do have a lot of them are, Suncor, Cenovus, they have that whole net zero pact. So you could play it from that end. But then, I think a lot of the new exploration plays, you're probably not looking in North America. You're probably looking kind of Latin America, Africa, North Africa, stuff like that.
Is the spec trade back for oil that way though? Look, it's kind of like looking at that, the PE ratios and the, production curves and all this fun stuff. That's all talk of a bear market. When we end up if this is a bull market and everybody's excited again, is there a spec trade in oil? Is exploration back on?
Well, right now the producers are trading at such discounted values that exploration is underperforming production, because the average person's looking at the valuation of the producers and just go, well, if I get another month of $100 oil, then this company's 3x multiples, really 2.8. So, I work for an exploration company. We're focused in Namibia and Botswana. And, earlier in the last month, there's been two major offshore discoveries, one by Shell and one by Total Energies offshore Namibia, that could rival the success that Exxon and Hess and CNOOC have had offshore Guyana. And Namibia is becoming a very big hotspot. We're doing it onshore, which is cheaper and has shorter cycle times, but there are going to be exploration opportunities at some point, because as I noted, the world is running out of barrels. Supply and demand will be imbalanced as long as demand is strong and population growth exists and economic activity exists. So, we're where we are because we know Africa is going to be a good place to be invested for a long time. In the area where we operate, people don't have fresh running water. They don't have access to electricity, things like that. So, I've taken my personal view and done my career that way. And that's where I am. But, there are going to be exploration opportunities. There are going to be places to look internationally. But for right now, from a risk reward perspective, from an ESG perspective, the market's saying, I'll just invest in Canada and I'll invest in the US and, benefit from buybacks and dividend growth.
Mm-hmm. Mm-hmm.
We haven't gotten into that exploration craze yet, because obviously there was the 900 million offshore Namibia deal that got done in 2010, 9, whatever it was, that ended up not working, but you had a lot of interest there back then. And so you had that craze, that wave of offshore, when you had your 3D seismic buying, right? So
yeah, it has worked. It's just taken 12 years. The problem with offshore is it takes forever, forever and ever. And that's why I'd always like to be onshore. Your issues with communities and the governments and things like that are much more intense when you're onshore. But when a country doesn't have a strong economic foundation, resource development is a huge bonus for everybody. And given that it's 2022 and we're a Canadian company, we're going to do it right.
Omar, what do you think? What do you think we can find out there? Where's the investor plant his or her dough in this space? Craziness.
Yeah. I think if you're looking at sustained high oil prices at again like $90, $80, you can probably now go into like the smaller producers, like the 20,000 barrel per day producers or 10,000 barrel per day producers, and they're probably generating a significant amount of free cash flow. and you're just basically sitting on that, hoping to collect a dividend, get your buybacks, and that's kind of like, I guess, the boring play for North America.
So where do we start? Like, what's a good resource for an investor to? I mean, a lot of our listeners are going to be retail guys that are listening to this and saying, "Oh, holy shit, yeah, I saw this whole big move in oil, and how do I play it? Like, where do I start? Like, where's a good place to look up the deals?"
I always go with people. People make the companies, and Murray Edwards at CNQ is going to be the largest and best large cap company in Canada. It's what he's always wanted to be, and it's what he's become, and it's what he will stay being. So for large cap perspective, CNQ, it's probably a little bit more expensive than the Cenovus's of the world these days, but they're high quality, and if you want a little bit of value, maybe it's Cenovus. If you're going to go down to smaller scaled companies, you'd be looking at the Whitecaps and Kelts of the world, Tamarack Valley, another decent company, and those are all led by great management teams. And then if you're looking in the U.S., you can't go wrong with the big U.S. producers being EOG, Pioneer, Devon. Those would be the three that I would focus on. And if you're looking for a rebound historic problem child, maybe you'd take on the larger cap side, look at Oxy. They picked the wrong time to do the Anadarko acquisition, but now they've got a huge inventory of great assets to develop in a better oil price environment. So, and then at some point, exploration will be important, and people will care, and there will be big discoveries, and there'll be capital chasing that, because the problem with conventional existing producers is, you're going to get 20, in a great year, you'll get 20 to 50% returns, whereas with explorers, you'll get multiples of your current entry price. So, that's your risk reward differential between producers and explorers, and the timing, how long this bull market lasts will be, your answer as to when or if that explorer trade will eventually work.
Okay, so for the producers, we're looking at like the 10 to 20, 30, sorry, Matt, to cut you off. We're looking for like that sort of type of return. That's what we're talking about for these blue chip names, basically.
These names aren't going to go up multiple, they've gone up a couple 100%, and maybe they'll go up again if the world really does, really does start chasing the sector, if the capital really starts chasing the sector. But the sector doesn't need capital right now, and there isn't land. See, that's the other thing, that the last time there was land to chase, there was growth opportunities out there. There isn't growth opportunities this time. So maybe we do see a big round of consolidation, and it needs to happen. You shouldn't have 400 Canadian E&P companies in one Western Canadian sedimentary basin. So consolidation needs to happen. So that could be another catalyst that could kick things off. But the real winners were all the Whitecaps and CNQs of the world who were buying assets when times were bad.
Yeah, definitely. I think that, like, CNQ, I remember back in 2014 was smaller than Suncor, and now it's the largest oil and gas producer in Canada. So I think there already is consolidation in at least with the oil sands producers. I think, you probably start to see consolidation with Whitecap, Crescent Point. They'll probably start acquiring assets. And then, the smaller players like, I don't know, like Cardinal, Surge, those would be kind of playing the price of oil.
So guys, let's have some fun then, and kind of, let's put our names on the line a little bit. What do you like as an acquisition target? And then what do you like as the new exploration area of the world? Like where are people focusing once you do have that kind of move capital?
I've put my career into Namibia, so I'm not going to say Recon Africa and Namibia, and I'll say it 100,000 times every day if I have to. But we're going to develop a world-class onshore opportunity in Namibia, so I'm going to put my own self-promotion hat on. But in Canada, the great thing that's happened in the last, it was even 10 years ago it happened, is the play maps for the Montney and all the different iterations of the Montney and are out there, and you can see pretty much who's around who. Even Canadian Natural did a smaller acquisition in the Montney last year, and for the life of me, I can't remember its name, but more acquisitions will happen. And the other thing that we're starting to see from tying into ESG and tying into to what's happening in Russia and Ukraine right now is exporting natural gas from North America is going to be a bigger and bigger topic. Europe is going to need to replace, Germany specifically is going to need to replace a lot of that Russian gas that may or may not flow from Russia again. And Canadian and US producers are going to benefit significantly. Cheniere in the US is a big LNG exporting company, and they've got partnerships with some of the big US gas producers. So, your Chesapeakes of the world, have reinvented and they're not, gas is labeled green as a energy transition fuel by the EU. Not a lot of people realize that, and there's a lot of environmentalists that aren't happy with it. But you need gas, and natural gas is going to be probably a much better priced commodity than it has been for the last decade. So gas was free pretty much for sub $3 for forever, and now it's $4.50, and it probably stays above $3.50 even during the summer months this year, and might get back to $5 or $6 again next year if you have enough LNG exports out of the US. So don't discount gas the way it used to be, but it'll tick more boxes from an institutional investor capital perspective on an ESG side, but oil always gets all the glory.
Omar, where are we exploring, and what's getting bought?
I personally, and I've always thought that Cardinal Energy would be bought by someone in Canada, just because they have low declines and all that, and they're pretty good to the price of oil. I would, as a consolidator, I would purchase something like Whitecap, just because I feel they do a really good job. They acquired, I think, 2 privates in a public company recently or last year, and I think they've done that pretty well. Exploration, I personally am not really interested in investing in any exploration plays. It's probably more just like companies that are for example, at an $85 oil price, Whitecap generates like 1.3 billion in free cash flow. So I would kind of rather expose myself to that than something, a little uncertain. Maybe they have like 50% exploration, 50% production exposure. That would be something. But for now, yeah, it's mainly free cash flow.
All right, so Whitecap, Cardinal, and Namibia.
That's Omar was like the biggest oil punt junkie in the world, and all of a sudden he's Mr. Cashflow for some reason. You like oil plays in Kurdistan.
I'll give you another one. Africa Oil is a Lundin family company that has access to the actual discovery offshore Namibia that was announced by Total Energies last year, and they again did a big acquisition in Nigeria during the downturn. So they're spitting out a bunch of cash. They announced a dividend for the first time today. And that could be a good company. IPCO is another. I don't know why the Lundins have some.
When I was in Ghana, there was a bunch of drilling off the shore in Takoradi. That's exploded. There's tons of people there now. And, really,
Anadarko and Tullow were big offshore Ghana, West Cape 3 points back then, and that's out producing now, and it's Cosmos Energy and Tullow that are producing there. Again, there was a transaction there where Cosmos bought out their partner recently, and the companies that were brave and did acquisitions and had the balance sheet or the financial backers to do transactions in the last couple of years are really strategically minded people who are going to benefit as prices are now above 100 again. But everybody's going to benefit. Suncor's only up 50% in the last year. It can go up another 30-40% easy.
Denny, this probably is a good time for listeners to put a risk note on offshore spending is really high. So if some private company comes to you and is raising $20 million and says they're going to drill 3 wells, tell them that they're not. So just be wary about what you're putting money. I've lost so much money in those sort of things. So everyone, just as a quick lesson ahead of time.
Yeah, be careful. I mean, look, at the end of the day, people got to do what they want to do. We're trying to get some good ideas for investing. Definitely try to steer some people away from mistakes that we've made in the past. And as Matt's saying, there's a million different ways to play it. Is there any cool tech in this space? Is there a tech angle to play on oil? Like, are we? Is there anything transformative out there that you guys like?
The tech angle that was played was all in completions back in the 2010 to 2015 time period, where they were going to frack the Permian using these things called cubes and cube the Permian, where you do 200,000 fracks out of 14 wells, and it was and then they discovered something called parent-child or parent-child intervention or interference, because if you frack wells too close to each other, you'll end up stealing the production from one well from the other. So the technology is not there. The technology really comes on the alternative energy side and on battery tech for your car, battery tech for everything. If you can get anything in this planet, all the capital you want, if you can develop an energy storage solution. Energy storage is the number one underinvested thing because the technology doesn't exist. The only thing we know about energy storage is there's batteries, and there's some water streaming, tech where you pump about a bunch of water uphill when prices are low, and then you let the water run downhill when prices are high in the peak demand time. But energy storage is a critical solution that needs capital, needs investment. We need real solutions for it. So, although we're here talking about oil prices, don't forget about, the energy transition is real and it's going to happen, but energy storage is what needs the capital and where we need the technological breakthrough.
The EV, the battery revolution. We know all about all of these scammy type of bullshit.
There's not enough lithium. You guys need to tell me there's not enough lithium. And
there's so much lithium. There's so much lithium.
I guess it's like uranium. Uranium's the only energy source that doesn't have a supply-demand limitation because there's uranium in everything.
Uranium's cool, but ever since Fukushima, everyone fucking hates it. And actually, it's green and it generates a lot of electricity. It literally
nuclear's a great option. It's just it's just weird that the ESG movement, it's moved against nuclear because it's the ultimate.
No, it's gaining a lot of mainstream traction now. You have a lot of talking heads that are spearheading, the green revolution. Elon Musk, Bill Gates, they're all cool with uranium now.
It's coming back.
Bill Gates has always been cool.
Well, I was talking to someone who was working with Oliver Stone to make a movie about the benefits of uranium 3 years ago, and the movie's still not made. So I'm still not convinced that everybody's over that, Fukushima fear.
Yeah. They made a documentary on it called Chernobyl, I think.
Yeah, that's what changed everybody's minds again. I forgot about
Chernobyl. Everyone felt really good after watching that, and they're like, "Yeah, it's uranium."
Yeah. No, but uranium and nuclear power is the ultimate, energy transition solution. Yeah. It's just unfortunate. Unfortunately, the green movement doesn't, the ESG movement doesn't really know when to stop, I guess is the right way to say it. We are all on board in energy transition. It's just the fact that, you still need gas and you still need oil and you still need lots of stuff.
Yeah.
Until we get to scale and have real solutions. You can have political policy all you want, but you're never going to change thermodynamics, physics, and maths. So
Friedland for like 3 years has been pitching hydrogen, but then you saw Hyundai come out and all their hydrogen car tests. I think it was Hyundai. They came out and all their hydrogen car tests didn't work or something, and so it's just longer time frame, right?
Well, there's not enough electrolyzers for hydrogen, so there's bottlenecks in everything, and we can't even get cars built these days because there's not enough chips for them. So whether that's electric or internal combustion, it doesn't matter. Ballard Power in Canada has been doing hydrogen fuel cells for 20 plus 30 years maybe. and it works selectively, but not reliably and not scalably. So, we need these solutions. The only thing that gives me confidence about hydrogen is the fact that there's a lot of big companies getting behind them, and the fact that F1, where there's a huge amount of technology invested, seems to be supportive of a hydrogen future.
On the oil and gas side, I think there is a lot of, with the investing in the energy transition, there's a lot of opportunity in carbon capture, usage and storage. And so, there's some companies out there, that Whitecap is an example, and then all the oil sands producers, they're investing and they're looking at carbon capture, usage and storage as an alternative. So, obviously not a near-term investment, but more of a long-term thing.
And these companies, just to be clear, these companies are buying like carbon capture credits, right? They're buying carbon credits galore to offset their production.
You have a whole other podcast about understanding carbon credit capture.
Yeah. Well, this
for sure. I mean, anyway, I have my own.
I'm invested in carbon credit companies because I think it's fascinating. I track it every single day. You've got European carbon credits that were up until 2 days ago trading over 90 euros a ton, whereas you had Chinese carbon credits, either official ones trading at $9.16 a ton or $11 a ton, depending on whether it is Chinese official or Guangdong credits. And there's such an arb there.
Yeah.
It's not surprising.
Well,
is that good?
I
have some carbon.
Chinese carbon capture credit sounds a little bit like the copper stockpile.
It's an opaque market when every single commodity trading house loves it. When Trafigura, Gunvor, Glencore, everybody's getting hard into carbon credits, it's going to be a big industry. And the fact is, it's just, I don't know how you monitor it, evaluate it, rate it, all this kind of stuff. It's such a nascent industry, but it's going to be big. Carbon, Canada has a carbon tax, which is a little bit ludicrous for a country of, 35 million people that are spread out everywhere. But
that's what scares me. I mean, again, like Matt said, we could have probably a whole separate podcast on that, but that's what scares me about that trade is it's so political. Like literally you decide that all of this environmental alarmism is not a thing anymore, which is very real, that's a possibility that's true, right? Like that we look at it and say, okay, great, but we have other fish to fry. All of this carbon stuff that we've been going on about, this whole, Al Gore inconvenient truth, freaking out, IPCC, all this Greta Thunberg stuff, park that for a second and go, okay, well, maybe it doesn't really make a big difference. What happens to this entire fucking house of cards carbon market? All these derivatives, like these carbon capture credits and things, could that go away? I think it could go away. I think all of a sudden, bam,
Poland was asking for the EU system to go away yesterday.
In Canada, I don't think it's that big of an issue. I think on the other side, if let's say, for example, the Conservative government came in, or they wouldn't really scrap a carbon tax. They'd probably create more incentives for these companies. So one thing is right now there's no offset. You can't get an offset for using carbon in enhanced oil recovery. That could be something that they offer, right? And so
they're going to play in the arena of this big, massive carbon capture market that's been.
Yeah, I think it's enough people. There are enough people behind it that they wouldn't get rid of a carbon tax or a price on carbon, at least in Canada. But yeah, they'll play around with the peripheral stuff like offsets and stuff like that.
Okay, so I think that's a good topic because that seems very, very early on.
Mm-hmm.
Not like trying to make 40% on a mega large cap oil company. It's
nothing wrong with that. That sounds pretty good. I like 40%.
You like 40%, but I think I would roll the dice. I don't know about oil.
It's a very mature sector. It's like tobacco. It's all about cash flow and giving back value to the shareholders at this point.
If you look at tobacco, it consolidated after everybody stopped smoking. It consolidated, and there's a lot of things that are said about oil and gas and have been said about oil and gas in the last 10 years. But my two favorites are one's relating to tobacco and the fact that there's still 18% of the world's adults smoke. and we all know it kills you. So if you think energy transition is going to happen quickly, there's still 18% of, living adults that smoke, and they know it kills them every day. And the second thing that's always said about, the energy industry and its, surmised death is, the Stone Age didn't run out of rocks. It didn't end because we ran out of rocks, but we use more rocks today every single day than we've ever used. So, we just don't use them as tools. So we're going to use oil and gas for a long time. And the fact that we've just gone through 5 to 7 years of underinvestment is going to prove very critical in the next 5 to 10 years.
Well, look, emerging economies, developing nations are going to guzzle the shit by the gallon. It's not. I mean, it's far from gone. It's still going to be a very much big piece of the world.
Just wait till this summer, and we have wave 2 of post-COVID travel and getting out there to do things. It's already out there. We're only kind of 15 to 18% below 2019 flight levels, and flight, international travel still non-existent.
That's a good point. We haven't felt the pain of that yet, right? Like, we've already felt the pain of oil prices and our consumption being expensive and everything going up crazy.
My hope that everybody was going to start flying around this summer might be reduced, because it won't be affordable to fly for anybody come the summer if oil stays at $100 a barrel or more.
Good point.
The other thing, for emerging countries, the oil price shock is a lot more damning economically than it is in North America, because in India, for example, if you price oil in rupees, or in Europe, even if you price oil in euros, they're at all-time highs. So, the price of a barrel of $100 barrel today is more than it was when it was $140 back in 2008.
That's a crazy.
That's a great tidbit right there. I did not know that.
So watch the economics. Like I said at the beginning, high oil prices will correct because of high oil prices. But it's always a fun industry because it's global, with lots of local content opportunities, and that's why I guess you invited me on here to talk about it.
Yeah, well, look, it's been a treat, guys. Thank you so much for approaching the hour. Really appreciate all the dialogue, the space. Wish you the best of luck in this space, and thanks for giving us a bunch of advice on your insights on it. I mean, it's been definitely educational for me. I'm sure the other guys too.
That was great, guys.
Thanks for coming on and doing this, and hopefully we'll have you back and get a catch up as things progress, and maybe oil crosses the $2 threshold. We'll see how our white cap. What were the names? White cap.
We got White Cap and Cardinal from Omar, and then
Cardinal,
anything in Namibia.
Yeah,
exactly.
Yeah.
Cardinal, Tamarack Valley, White Cap, and then if you wanted a discounted large cap Canadian, I guess Cenovus is the cheapest of the lot. But
okay, so what's the time frame?
CEO.CA like portfolio. Fucking buying an equal amount on a mock portfolio basis, and see how we do, and then invite these two beautiful gentlemen back on and show them how much money we've made or lost.
Well, then we need to throw Recon Africa on that list as well, and when I come back, hopefully it'll be the best performer.
I'm putting all of my kids for ESP. So.
I'm mortgaging the house, and I'm going to put it all on Recon.
Yeah.
Well, all right. We've got 8.5 million acres in Namibia and Botswana. That's if on a land basis, we'd be the 4th largest Canadian oil and gas company, only behind C&Q, Cenovus, and Suncor. So we're pretty good from a land perspective. We just don't have the infrastructure and the development because it's never produced oil and gas, but we're going to get there.
Cool.
Is it expensive to get a rig there? Or
we bought our own.
Oh, okay.
That's how expensive it was. We bought our own, so we
do you have to
own
take like
rig.
5 different routes every time you go to site, and like carry? Like, how is it? Is it pretty safe there?
Namibia is a great country. It's I remember a guy called Gabe Olivier calling it Africa for beginners because it was a former German colony. The infrastructure is great. The roads are wide. It's got a deep water port. It's got everything you need. It's for Africa, it's underpopulated. It only has 2.5 million people.
And Grayson, for the listeners above, that's Reconnaissance, right? We got RECO as a
Reconnaissance
ticker.
Energy Africa, Recon, RECO.
Perfect. Congratulations on your 50 million bought deal. That's great.
We just closed that today, so we got an extra 44 million bucks in the bank. We got $80 million now to drill a bunch of wells and shoot a bunch more seismic.
And what's your market cap?
1.2 billion.
1.2 Bs. Okay.
All right. Cool.
Everybody, it was 70 cents a year and a half ago, and we're a $6 stock now. So everybody goes, well, I missed an 8-bagger. There's still a long way to go. Still a long way to go if we have success.
Well, from the looks of it, you were just $14. So if it's $6 today, it was 14 a year ago. So that's
Well, basically what we did is we took this rig that we bought, we drilled 2 holes randomly in the middle, at the edge fringes of the Kalahari Desert. We found oil and gas shows without seismic, just
Very
using
cool.
an Aeromag survey. So if we can do that off an Aeromag survey, imagine what we can do with some seismic.
very cool. One to watch for sure.
Yeah, it's exciting. Exploration is exciting, as you guys know.
Yeah.
Best part.
Mm-hmm.
Absolutely.
Okay. Well, thanks again. Thanks, gentlemen. And I hope everybody has a great day.
Thanks,
Thanks,
Denny.
Om.
Thanks,
Thanks,
Matt.
Greg.
Thanks, Grayson. Nice
CJ.
meeting you guys.
Great meeting you, Omar.